You're standing on the dealership lot. The salesperson just said the magic words. This one qualifies for the tax write-off. Your buddy did it last year. He wrote off the whole truck. Well, at least that's what he told you. It's December and everybody says buy it before the 31st. Here's the truth. Most of what you heard is half true. And the half that's left out is the part that the IRS actually checks. Today, I want to walk you through how this deduction actually works, who it actually works for, and what Hawaii does to the math that no one online will actually tell you. And exactly what you need to document so the deduction you take is the deduction you keep. My name is Ethan Ho. I'm a certified financial planner and the founder of Cloud Capital Partners here in Hawaii. I help business owners and high-income earners stop making financial decisions based on hype and start making them based on clarity. If you want real practical content, hit subscribe and follow along. All right, let's get into it. A client called me recently. They run a business that genuinely needs a heavy vehicle. Real equipment, real job sites, real miles. And they were planning to purchase, but here's what made the call stand out. They were not calling to ask if they could write it off. They were calling to ask how to do it right. Before buying, before year end, before a single dollar moved. That order of operations is the entire difference between a deduction that will actually hold up and a deduction that falls apart 3 years later with penalties and interest attached. This video is the conversation that we had. Let us start with what is actually true. The vehicle deduction is true, and for the right business owner, it is genuinely powerful. Here's how it works in plain language. The magic number that you keep on hearing about is 6,000 pounds. That is gross vehicle weight rating, GVWR. It's not how much the truck weighs, it's the maximum loaded weight that the manufacturer rates it for. Vehicles over 6,000 pounds, GVWR, escape the annual depreciation caps applied to regular passenger cars. That's why everyone talks about heavy trucks and big SUVs. But here's distinction number one that the dealership is not going to explain. A true work vehicle, a pickup with a full-size bed, a cargo van, these can qualify for full first-year expensing up to the federal limits. A heavy SUV, the kind with leather seats and a third row, they can get capped. For 2026, the Section 179 limit on a heavy SUV is roughly $32,000, not the full purchase price. Now federally, bonus depreciation can pick up the rest. It is back at 100% and it is permanent now. So at the federal level, that big first year number that you heard about can be real. But there are 3 conditions attached to every dollar of it. Condition 1. Business use has to be over 50%. Condition 2, you only deduct the business use percentage. An $80,000 truck used 70% for business is a $56,000 reduction, not 80. Condition 3, the vehicle has to be placed in service by December 31st. Placed in service means in use, doing actual business work. Ordered does not count, paid for does not count, sitting at the port waiting to be delivered does not count. And one more thing that I covered in a previous video, but it belongs here too. A deduction saves you the tax rate, not the purchase price. A $48,000 deduction at a 28% effective rate saves you around $13,000. You are still out the rest, so keep that math in your head for the whole rest of this video. So now here's where it gets interesting because everything I just described is the federal picture. In a few minutes, I'm going to show you what Hawaii does to these numbers. And I promise you, almost nobody making these videos has mentioned it. But first, I want to go over 3 types of buyers that I see making this purchase, because which one you are determines everything. Driver number 1, the contractor. Construction, electrical, plumbing, landscaping. The truck is not the tax strategy, it is the business. It hauls material to job sites, it carries equipment, it lives its life working. For this driver, the deduction is exactly what Congress intended. Business use clears that 50% without even trying, and business use matches the work. The only thing this driver needs is the paperwork, and we'll get to that. Driver number 2, the realtor. And to be clear, I'm not picking on realtors. This applies to consultants, sales professionals, anyone whose business involves real driving, but vehicle also lives a real personal life too. Here's the honest truth about this driver. The IRS does not require that you need a heavy vehicle. The legal standard is ordinary and necessary. And necessary really just means appropriate and helpful to the business. Nobody at the IRS is going to ask, why don't you just buy a Corolla instead? What they're going to ask is one question. What percentage of your actual miles were actual business miles? Driving clients to showings, hauling signs and staging materials. open house runs, genuinely business. Driving from home to your office or the first appointment of the day, that is commuting, and commuting is personal. That one surprises almost everyone. Groceries, kids, weekends, it's personal, personal, personal. The contractor's truck clears business use easily. The realtor's SUV oftentimes does not. And here's the trap. If your business use drops to 50% or below in any year during the recovery period, the accelerated deduction that you took gets recaptured, added back to your income, and taxed. The deduction may have been legal on paper, but the actual life of the vehicle did not match the story. So if you're driver number 2, the question is not, am I allowed to do this? The real question is, will my real usage actually clear the bar, and can I prove it? Driver number 3, you already know who this is. I talked about this driver in a previous video about tax strategies. The luxury SUV you bought in the last week of December because it hits the weight limit because someone on the internet called it a tax play. Driven like the personal vehicle it actually is. And if that is the plan, this video cannot help you, and honestly, neither can your accountant. Now the part I promised you. Now everything you heard about this deduction, every video, every dealership pitch, every buddy at the beach telling you he wrote off the whole truck, those are federal numbers. Hawaii has their own rules, and they're printed right at the top of the state's own tax form instructions. This is a direct quote. Hawaii has not adopted the increased expensing deduction under Section 179. Hawaii limit is $25,000 or the bonus depreciation provisions. Let me translate that. The federal Section 179 limit in 2026 is over $2.5 million. Hawaii's limit is $25,000. And bonus depreciation? The 100% first-year write-off that makes all those videos so exciting, Hawaii does not recognize it at all. Any bonus appreciation that you take federally gets added back to your Hawaii income and recovered slowly over the normal multi-year schedule instead. Let me show you what that means with real numbers. Say a contractor here in Oahu buys a $60,000 work truck, uses it 80% for business, that is a $40,000 deductible basis. On the federal return, potentially all $48,000 deducted in year 1. On the Hawaii return, $25,000 maximum under the state Section 179 limit. Zero bonus depreciation and the rest spread out over years. Roughly half the year 1 deduction does not exist at the state level. And with Hawaii income tax rates running up to 11%, the state side of this is not small money. And to be clear, you do not lose the deduction. You still get it on the Hawaii return, it just comes slower, spread over years. You don't get it all at once. The deduction is still worth doing and worth doing right. But if the entire purchase was built on the year 1 number made from a video from someone who is located in maybe Texas or Florida, your Hawaii return is going to tell you a different story come April. This is why working with someone who knows the Hawaii rules can change the math before you sign instead of after you file. Now let us talk about the part that determines whether you keep the deduction you take. Everything hinges on one document, the mileage log. Not a guess at the end of the year, not a reconstruction when the audit shows up. A contemporaneous log, which is a fancy way of saying recorded as you go. Date, destination, business purpose, miles. The good news is that this is easier than it has ever been. There are apps that track it automatically in the background that allow you to swipe each business trip or personal. 30 seconds a day, that would be the entire cost of protecting a 5-figure deduction. The IRS knows that vehicle deductions are one of the most abused areas in the entire tax code, which means they know exactly what to ask for. And when there is no log, the deduction does not get negotiated, it gets denied, along with penalties and interest calculated in the year that you filed. Beyond the log, keep the purchase documents, the GVWR sticker photo from inside the driver's side door, proof of when the vehicle actually went into service, and records showing the business actually paid for and owns the vehicle. And one more commitment worth understanding before you buy. This is not a 1-year use decision. The business use test follows the vehicle for the full recovery period, generally 5 years. Drop to below 50% usage case in year 3, and the recapture rules claw the excess deduction back. Sell the truck early, because that deduction reduced the basis to 0. Most of what you sell it for comes back as taxable income. And none of this is a reason not to do it, it's a reason to do it with your eyes open. Before I close, here are the 5 red flags that get vehicle deductions flagged. Red flag 1, claiming 100% business use. Almost nobody actually uses a vehicle for 100% business, and the IRS knows it. A real log almost always shows something under 100, and a claim of 100 looks like a real guess. Red flag 2, 100% business use claim with no other vehicle in the household. If the truck is your only vehicle, how did you get groceries this year? That question has ended a lot of audits badly. Red flag 3, the December 31st purchase with a massive first-year claim. Buying at year-end is legal, but a vehicle placed in service with 4 days left in the year, claiming a full year of heavy business use invites questions that need documentation to answer. Red flag 4, no log or a log created after the fact. Reconstructed logs have a look. Same pen, same handwriting, pressure, suspiciously round numbers. Auditors see hundreds of these. Red flag 5, a vehicle that does not match the business. A luxury SUV deducted by a business with no clients to drive, nothing to haul, no job sites to visit. It tells a story, and it is not the story that you want to be telling. Let me bring this back to the client who inspired this video. Before they bought anything, we asked one question. Would you buy this vehicle if there were no deductions at all? And the answer was yes. The truck does real work. It earns its keep whether the IRS allows the deduction or not. The deduction is the bonus, not the reason. This is the entire test. If the vehicle makes sense for the business on its own merits, then take the deduction. Take it correctly, document it properly, understand what your Hawaii return will actually look like, and enjoy the real savings. But if the deduction is the only reason that you're standing on that dealership lot, go back and watch my video on letting the tax tail wag the dog. Because a purchase that only makes sense because of the tax benefit usually does not make sense at all. This is general education, not specific tax advice. Your situation depends on your business, your entity structure, and your numbers. So run your specific plan through a qualified tax professional before you sign anything. If you found this useful, hit subscribe. I keep putting out practical Hawaii-specific financial planning content, and I want to make sure you see it. And if you're a business owner here trying to build wealth with clarity instead of hype, that is exactly the kind of conversation that we have at Claw Capital Partners. Head to clawcapitalpartners.com, linked in the description, schedule a discovery call, and I'll see you in the next one.